Welcome back to our Investing 101 series. Today, we're turning our attention to a critical yet often misunderstood component of many investment portfolios: bonds. Bonds play a crucial role in providing stability, income, and diversification, especially for investors looking to balance risk. In this session, we'll break down what bonds are, how they work, and the different types of bonds available to you. We'll also explore how to incorporate bonds into your investment strategy. Whether you're seeking steady income, preserving capital, or achieving a balanced portfolio, a bond is essentially a loan made by an investor to a borrower, typically a corporation or government. In exchange for this loan, the borrower agrees to pay the investor periodic interest payments, known as coupon payments, and to return the principal, or face value, of the bond at maturity. Bonds are considered fixed income securities because they provide regular income payments over time, which can be a stable and predictable source of income for investors. Bonds are classified into several categories based on the issuer. The most common types are government bonds, corporate bonds, and municipal bonds. Government bonds, such as U.S. Treasury bonds, are generally considered the safest, as they are backed by the full faith and credit of the issuing government. Corporate bonds, issued by companies, offer higher yields than government bonds but come with more risk. Municipal bonds are issued by states, cities, and other local government entities, and often come with tax advantages, such as tax-free interest income. The price of a bond can fluctuate based on changes in interest rates, economic conditions, and the creditworthiness of the issuer. When interest rates rise, bond prices typically fall, and vice versa. This inverse relationship between bond prices and interest rates is a key concept for bond investors to understand, as it impacts both the value of existing bonds and the potential returns from new bond investments. Bonds can be a valuable addition to an investment portfolio because they offer diversification benefits. Unlike stocks, which can be volatile and fluctuate based on market conditions, bonds tend to be more stable and provide consistent income. This stability can help offset the riskier components of your portfolio, such as equities, making bonds an essential tool for managing overall portfolio risk. One of the primary reasons investors include bonds in their portfolios is to generate a steady income stream. Bonds pay interest, usually on a semi-annual basis, providing a predictable source of income. This makes bonds particularly appealing to retirees or those seeking regular income to cover living expenses. Additionally, the interest income from certain types of bonds, such as municipal bonds, may be tax-free, enhancing their attractiveness as an income-generating investment. Another important aspect of bonds is their role in capital preservation. Because bonds are generally less volatile than stocks, they are often used by investors to protect their capital, especially during times of economic uncertainty. Government bonds, in particular, are considered a safe haven asset, providing a reliable return of principal along with regular interest payments. This makes them a popular choice for conservative investors who prioritize the safety of their investments. Bonds can also be used as part of a broader asset allocation strategy. Asset allocation involves dividing your investments among different asset classes, such as stocks, bonds, and cash, to optimize risk and return based on your financial goals, time horizon, and risk tolerance. By including bonds in your portfolio, you can achieve a more balanced asset allocation, reducing the overall risk while still aiming for growth. The mix of stocks and bonds in your portfolio should reflect your investment objectives. Whether you're focusing on growth, income, or a combination of both, it's important to understand the concept of bond duration. which measures the sensitivity of a bond's price to changes in interest rates. Bonds with longer durations are more sensitive to interest rate changes, meaning their prices can fluctuate more significantly with shifts in interest rates. Investors should consider duration when selecting bonds, especially in environments where interest rates are expected to rise or fall. By managing duration, you can better align your bond investments with your risk tolerance and market outlook. Investors should also be aware of the credit risk associated with bonds. Credit risk refers to the possibility that the bond issuer may default on its payments, either by failing to make interest payments or by not returning the principal at maturity. This risk is particularly relevant for corporate bonds, where the financial health of the issuing company plays a significant role in the bond's safety. Ratings agencies, such as Moody's and Standard & Poor's, provide credit ratings that assess the creditworthiness of bond issuers, helping investors gauge the level of risk involved. Inflation is another factor that can affect bond investments. Inflation erodes the purchasing power of future interest payments and principal, meaning that the real value of the returns from a bond may be less than anticipated. To protect against inflation, some investors turn to inflation-protected bonds, such as Treasury inflation-protected securities, TIPS, which adjust the principal value of the bond based on changes in the Consumer Price Index, CPI. This can help preserve the purchasing power of your investment over time. Bonds are not without their own set of risks, but when used appropriately, they can play a crucial role in achieving a diversified and balanced investment portfolio. By understanding the risks, such as credit risk and interest rate risk, as well as the potential impact of inflation, you can make informed decisions about how to incorporate bonds into your investment strategy. Whether you're looking to generate income, preserve capital, or balance the risk in your portfolio, bonds offer a range of options to meet your financial goals. Lastly, it's important to periodically review and adjust your bond holdings as part of your overall portfolio management. As interest rates, economic conditions, and your personal financial situation change, you may need to rebalance your bond investments to ensure they continue to align with your goals. Regularly evaluating your bond portfolio can help you stay on track and make necessary adjustments. To optimize your investment strategy, bonds are a fundamental component of a well-rounded investment portfolio, offering stability, income, and diversification benefits that can enhance your overall investment strategy. By understanding the different types of bonds, the risks involved, and how to use bonds to meet your financial goals, you can make more informed decisions and build a portfolio that suits your needs. As you continue your investing journey, remember that bonds, like all investments, require ongoing management and review to ensure they align with your evolving financial objectives.